Next one, also quite relevant for today. Talk about market timing. What do you think about market timing, Peter Lynch? Peter Lynch, guys, if you're just tuning in, Peter Lynch ran the Magellan Fund. He's one of the most successful investors of all time. And in his, I think it was 16-year tenure running the fund, it went up 2,700%. So quite a solid return, I must say. So they're saying, Peter Lynch, talk about market timing. The market itself is very volatile. We've had 95... Hello. Something just went flying in my closet. That's cool. So going back to that, we've had 95 years completed of this century. Okay, so this interview was in 1996, I guess. We're in the middle of 96, and we're close to a 10% decline. In the 95 years so far, we've had 53 declines in the market of 10% or more. Not 53 down years. Okay, so that's once every 2 years. Of the 53 declines, 15 of the 53 have been 25% or more. That's a bear market. So 15 in 95 years, about once in every 6 years, you're going to have a big decline. And I think we were having some debate a little while back talking about, was last year's, does that count? Because it was not caused by, some random economic stuff, but it was caused by the epidemic. I would say it probably does count because a lot of these other factors are, wars or things happening around the world and stuff like that. So kind of every 6 years, you should expect to have something big like that, which is also fascinating to keep on your mind, which is another reason to keep cash on hand. But he says, now no one seems to know when they're going to happen. At least if they know about him, they're not telling anybody about him. I don't remember anybody predicting the market right more than once, and they predict a lot. So that's going to happen. If you're in the market, you have to know there's going to be declines. And they're going to cap, and every couple of years, you're going to get a 10% correction. That's a euphemism for losing a lot of money very rapidly. That's what a correction is called. And a bear market is 20, 25, 30% decline. They're going to happen. When they're going to start, no one knows. If you're not ready for that, you shouldn't be in the stock market. I mean, stomach is the key organ here. It's not the brain. Do you have the stomach for these kinds of declines? And what's your timing like? Is your horizon 1 year? Is your horizon 10 years or 20 years? If you've been lucky enough to save up lots of money, you're about to send one kid to college and your child is starting a year from now. You decide to invest in stocks directly or with a mutual fund with a 1 year horizon or a 2 year horizon. That's silly. That's just like betting on red or black at the casino. What the market's going to do in 1 or 2 years, you don't know. Time is on your side in the stock market. It's on your side. And when stocks go down, if you've got the money, you don't worry about it and you're putting in more, you shouldn't worry about it. You should worry what our stock's going to be 10 years from now, 20 years from now, 30 years from now. I'm very confident. So again, that long-term perspective. The longer you're in the stock market, the higher your chances are of winning. It's kind of like the opposite of Vegas, the casinos, The more transactions you do in a casino, the more those odds are going to stack up against you, 52 to 48% or whatever it is. You might go in and, hit the jackpot once or maybe even twice in a million years. But the longer you're in there, the more likely you are to come out negative. And it's the opposite for us being in the stock market, interestingly. Let me know what you guys think about that. I'm kind of interested to ask you guys, how many transactions a month do you guys do? Is it maybe adding to one position once a month kind of thing? Or is it a few transactions a day? I always like to get to know you guys more so I can kind of tailor the content a little bit more to you guys. Today, we're looking at Peter Lynch. He's giving a lot of kind of basic foundational advice for people, which I think is helpful, especially for beginners, but it's also helpful for non-beginners like me to get perspective from, these guys who've been doing this for a lot longer than I have. But yeah, let me know how often, 1 or 2 a month. Silver Spoon 16, what's up? Thanks for joining. So we got 1 or 2 transactions a month. I would say I probably, in the average month, it's probably 5 or 6, something like that, 4, 5 or 6. So I'm not super duper active. But when we saw stuff last March, April, I was doing like a lot every day. I was just like, buy. It would go down 10%, buy more of a bunch of different stocks, and then go down 10%, buy more, a bunch of different stocks kind of thing. So I'm prepared to do a lot more than that. But generally, I just want to be kind of like buy and hold. Lonely Otaku, almost every morning, buying and selling. Interesting. What about the rest of you guys? Clowning around, I buy whenever I have cash. It all depends on money in the market. Rob B, I find that I know all this stuff, but for me, it's important to constantly hear and reinforce. If there is even a 6% market dip and you haven't heard this advice in a long time, you get worried. Yeah, seriously, man. That's why I'm kind of enjoying doing this series. A lot of this isn't new, you know. Like Druckenmiller said last week, they're like, what lesson did you learn after you lost $3 billion in one day? And he's like, I didn't learn a lesson. I already learned that lesson like 20 years ago. I just friggin' forgot. And then he was sharing about basically the dot-com bubble. He had timed it pretty well and he had like cashed out basically, but he saw a bunch of his, the other fund managers around him who stayed in and got even more gains than him. And every day he would just watch them and be like, oh my gosh, I'm missing gains. I'm missing out. I'm missing out. I'm missing out. And then he's like, dude, screw it. I'm getting back in 1 hour before the dot-com bubble crashed. And then I think he said he lost $3 or $5 billion in like an hour, which is like, whew, I can't even, that it like hurts just to even talk about that. So yeah, thanks for sharing that, Rob. During the COVID crash, listening to people like Peter is what gave me the confidence to buy during the crash. Yeah, seriously, same here. Guys, let me know in the comments section, how many transactions a month do you do in the stock market? So let's get back into it. Peter Lynch, if you had invested in 1966, it would have taken 15 years to make the money back. They call that a question. That's actually not a question. That's a statement. It says, well, from 66 to 82, the market was basically flat, but you still had dividends in stocks. You still had a positive return. You made a few percent a year. That was the worst period other than the 1920s in the century. So companies still pay dividends, even if their stock goes sideways for 10 years, they continue to pay you dividends. They continue to raise their dividends. So you have to say to yourself, what are corporate profits going to do? Historically, corporate profits have grown about 8% a year. 8% a year. They double every 9 years. They quadruple every 18. They go up sixfold every 25 years. So guess what? In the last 25 years, corporate profits have gone up a little over sixfold. The stock market's gone up a little bit over sixfold. And if you had a 2 or 3% dividend yield, you made about 11% a year. There's an incredible correlation over time. So you have to say to yourself, what's going to happen in the next 10, 20, 30 years? Do I think the General Electrics, the Sears, the Walmarts, the Microsofts, the Mercks, the Johnsons and Johnson & Johnsons, the Gillettes, Anheuser-Busch, are they going to be making more money 10 years from now, 20 years from now? I think they will. Will new companies come along like Federal Express that came along in the last 20 years? Will new companies come along like Amgen that make money? Will new companies come along like Compaq Computer? I think they will. There will be new companies coming along that make money. That's what you're investing in. He makes it feel so simple and clean and straightforward. So he's saying, even though it was a flat market from 66 to 82, if you're in solid companies that are paying a dividend, you did all right. That's also another interesting thing for me to consider, because I'm like I don't like seek dividends. I'm not like, wow, that's a really good dividend stock, I'm getting in. You know, with companies like Nokia, I'm primarily getting in because I see how undervalued they are. And it's been doing magnificently, actually. It's like up 70% or something in the last few weeks. And it's like, dude, this is awesome. But the cherry on the top is that I know that in 2023, probably they're aiming for, they might reinstate a dividend, you know? And so if you buy thousands of stocks while it's like a $3 stock, probably the dividend, even if it's like 1%, is still going to be pretty decent, you know? And then you add on top of that the potential price appreciation because it was so undervalued for a while. So stocks like that, it's like, yeah, I'll probably have dividends, even if it just goes sideways for 15 years. But a lot of my portfolio, Tesla, Palantir, probably even Dropbox, A lot of these kinds of companies are just kind of like, nope, we are not in that mode to pay dividends. So I don't know how those would work out, in a 15-year kind of time horizon.